All right, accounting. We're going to go ahead and get started with Chapter 3, Journalizing Transactions. We are now actually going to get into accounting and using an accounting form for each of the transactions, all right? Chapter 1 and Chapter 2 introduced us to some just accounting basics, the accounting equations, assets, liabilities, owner's equity. We've been introduced now to debits and credits and the different accounts that we're going to be using, okay? So chapters 1 and 2 were just kind of getting us ready. Now we're actually going to start doing accounting, all right? And the way we're going to do that is we're going to do what's called journalizing transactions. We're going to use what's called a 5-column journal. And we're going to take information from what's a source document, which I'll show you here in a minute. We're going to take information from that and we are going to put it into this journal. So when businesses, this is called journalizing, all right? Taking transactions and putting them into a journal. That's called journalizing. So if you hear me say that, that's what that means. Here's your 5 columns. You've got column 1, column 2, 3, 4, and 5, all right? So this is what our journal is going to look like. So why use a journal? Well, accuracy. It's going to allow us to show if our debits equal credits, which translates into the accounting equation being accurate or equal. Assets equals liabilities plus owner's equity. So it allows us accuracy. Chronological record. It's going to show everything that goes on in our transaction, and we're going to go chronologically starting from the beginning of the month, working our way to the end, and then going to the next month and the next month. So it allows you to look back if necessary and say, what happened on this day? And you have proof then that that's what happened. And so anyway, it's a chronological record that just keeps track of everything that goes on in your business. Using a journal, we're going to do what's called double entry accounting. And basically that means that there's going to always be 2 accounts affected. And I already talked about that last chapter with the T accounts. There's going to be 2 accounts affected. And the other thing, and I mentioned it again in chapter 2, but we're going to have 1 debit and 1 credit always. 1 debit, 1 credit, okay? Double entry accounting, 2 accounts always affected. And probably one of the nicer things about using journals is you can customize them to fit your business. There's not just necessarily one way that there's a journal. You can customize them. So you can include what are called special amount columns. And special amount columns are used for transactions that occur frequently. So for instance, cash debit, cash credit, and sales credit. Those 3 accounts are going to be affected for almost every one of our transactions, okay? And so these are called our special amount columns. So if you look back at our journal, here's sales credit. So the only number that's going to go in this column is going to be a sales credit. The only number that's going to go in cash debit is if we receive cash. And every time we pay cash, it's going to go there. If it does not, if the number that we're worried about does not go here, then we will be using what are called our general debit and credits, okay? So special amount columns are a really nice thing that journals allow us to make it easy for ourselves as we're doing our accounting. All right, real quick, source documents. We can't do anything in accounting without proof that it happened. And that proof is going to be called your source document. And basically it's a business paper from which information is obtained for a journal entry. And our accounting concept for this is objective evidence. This is the evidence that a transaction took place. We have 5 source documents. Every time we pay cash, that's why I almost should have put paid cash there, we're going to be dealing in checks, not actual cash. So every time we write a check, the checks and the check stub are going to be our source documents. Services sold on account. All right, every time that happens, we're going to make out a sales invoice to show that we made a sale. Whenever we receive cash, we're going to make out a receipt. I'm going to skip down here to calculator tape. Now that sounds old school, and with computerized cash registers and stuff like that, some of those cash registers still do spit out cash register tapes. Others, bigger stores, they probably get like a more of a just a printout at the end of the night. But you can find out how much of a cash sales were made from each of your cash registers. So we're going to be talking about calculator tapes, and that's just showing how much cash we received at that day. All right, and then basically we have what's called a memorandum. The memorandum is just a form with a brief message. Any source document that doesn't fall within our other four documents, we're going to use a memorandum, and I'll show you which document is affected with that. All right.